Morning, everyone. Good morning. Good morning. Top of the morning to us all, and good to have us in this session. Please let's kindly confirm if you can uh, hear me clearly. You can type in the chat box. All right, if you can hear me. Good morning. Good morning. And it's weekend. How are we doing today? Okay. Oh, great. Okay. So thank you for that. So let's get straight to it. No delay. Start starts on the dot. All right, so it's been a great time all this while, and I hope you are keeping well. I hope you are doing well, right? The economy is smiling, and we should not see otherwise. And I believe we are in good shape, right? It's always good because when you are in good shape, that you get to learn something and digest it, right? So I trust everyone. We are doing fine. So good to have us again. Let's get straight into it. The session will also be recorded, will be shared with us so that others can always watch the video and catch up um, with us, right? Now, what are the things we'll be touching today? Let's discuss structure of a balance sheet. Samson Ayodele, I'm not sure your mic is connected. Yes, so might not be able to hear us, right? Maybe someone can help us send a message to me. So let's take a look at structure of balance sheets, right? More like structure of our financial statements, incorporating macroeconomic assumption in our modeling. We also take a look at structure of a typical income statement and also something we call drivers in financial modeling. The whole modeling is all about drivers. Driver for me to forecast this line item. What do I need to do? And then we're going to have our interesting demo. So we try and start building our model from scratch. So I really want us to be 100% attentive. If you have any question you ask, you can always go back and watch the video, right? But I want you to ask as much question as possible, understand it. And that's the difference between you taking a self-paced course and a self-guide training, right? You have that, you are open-minded, you can ask questions, it's not as if it's a scripted thing. Okay, so let's start with our structure of income statement. I know most of us, we know about income statement, also known as our profit or loss account. Some people call it profit or loss account, either way, but for the purpose of our training, let's just call it structure of income statement or profit or loss account. Now, we mentioned that we have three components of financial model. Do we still remember? Let me see. Let's type in the chat box one that you still remember. We have said we have three components of model. All right, any model you want to build must always have those three components. Can we mention one so that I'm sure we still remember?
The input.
Okay, thank you for that. We can also make use of the chat box so that it's kind of smooth. Okay, so input, definitely. Thank you for that. So process, I'm not sure we mentioned process in our home. Okay. So we have input, we have output, right? Then we have one left. There are three. And calculations, right? So I think that's what someone is called process, right? So we have input, we have our calculation, and we have our output. And we said our output, that when it comes to you categorizing, hey, this model, what type of model is it? It is the output that determines the kind of model. So you could have a credit risk rating model, you could have a financial model, you could have a statistics model, you could have different type of model. So we said when it comes to financial model, our output is majorly our three financial statements, which you call income statement, balance sheet, and your cash flow. Now, every other thing that you do in your financial model, they are picking their variable, their data from these three financial statements. And that's why three income statement modeling is very, very important. Because everyone to do valuation, you create your free cash flow, investment evaluation, NPV, they are all picking their values, their data from these three financial statements. So which means the other thing about financial model is you forecasting your three financial statements, want to forecast your income statement, forecast your balance sheet. And you know, once you have these two, you can automatically get your cash flow. And as such, as a modeler, you now need to understand what is this financial statement saying, because it will be what will also guide you in getting your assumption when you want to build a model. You're asking your client, hey, for me to forecast this line item, what do I need? For me to forecast this line item, what do I need? So which means you need to understand financial statement and what each of this line item is saying, because that is what you are forecasting. Now, usually start with one guy, which we call revenue. Some call it sales, some call it income, some call it revenue. Don't mind we accountants, just we're trying to have different name, right? To some industry it is more like sales, right? To some it is income. Some even call it revenue. So revenue, income, sales, right? But they're just still saying the same thing. Now, this guy is very important to every business or businesses. Right? Okay, some even call it turnover. Thank you for that allusion. Some even call it turnover, but it's still the same thing. Now, irrespective of the industry, this guy is very important. In fact, they call it, we have one name we call it the umbrella of the business. Because revenue is very important. Even a non-profit organization still needs to generate income. They still need to generate revenue, even though they will call their own, no, it's more like inflow. But you need it because it is the umbrella of the business. It is the reason the business is being set up. And it is what drives the whole business operation. So as a modeler, you need to understand that you don't just understand profit or loss accounts the normal typical way. Say, oh, this is revenue, this no. You must be able to interpret it. Ask a question, and said is always beyond you just putting values in Excel. Right? So the revenue is like the umbrella of the business. And the good part is everyone is eating from this business revenue. Everyone is eating from the revenue. Revenue is so important because it is what is recognized as your own market share. And the management spend time trying to increase revenue as much as possible because it is the umbrella and everyone is eating from it. So which means if you have lesser revenue, then there's lesser things to eat. Let's look at the pandemic period. Our airline industry. During the pandemic period, there was shutdown, no traveling and everything. That industry actually suffered because they were unable to generate revenue. And what do you think would have been the next thing they had to do? They start laying off staff that, hey, we don't have something to cover you guys anymore. We need to let you guys go. Banks, oh, don't need some staff, everything. What just changed? Some companies even had to go and file for bankruptcy, right? That, hey, we don't have enough revenue or cash to sustain because it is the revenue that leads down to your cash. I hope you still remember operating our business cycle. Now, revenue is like the umbrella of the business and everyone is eating from it. The first person that eats from this, they eat in form of what we call cost of sales. In fact, the cost of sale is assumed to be the neck of your umbrella. So revenue, the umbrella, cost of sale is the neck that is actually holding that umbrella. Because cost of sales, they are more like the cost you need to incur to generate revenue, which means if you don't incur the cost, you might not generate the revenue. So they go together, they flow together. Some call it cost of sales, some call it cost of goods sold, Some call it direct cost. Some call it variable cost. It's not the same thing, which means without this cost, without you incurring this cost, you might not generate your revenue. So revenue umbrella, cost of sales is more like the neck, because if you don't incur that cost, for example, if you're selling something, if you don't buy the raw materials, definitely you don't buy the raw material to produce your good, then you have nothing to sell. You have no finished goods. So cost of sales comes next. Then after we deduct that, we now have the guy we call gross profit. And as a modeler, as an analyst, you don't need to understand that from revenue down to your gross profit, they are what makes up our top line item. And this is more like the main concern of the business. Now, remember I said revenue umbrella, cost of sales, those costs are unavoidable. You just need to incur it. Then you have your gross profit. Now, this gross profit is now assumed to be the next umbrella. So companies try as much as possible to, let's increase our revenue. But you know what? Let's manage our cost of sales so that it does not eat too much into our revenue. That's where when you have gross profit margin, that is what is saying. How efficiently have we managed our direct cost in generating this revenue? And we call it top line item. Then the next person, so the gross profit now becomes the next umbrella, right? And everyone is still eating from it. We have our SG&A, which we call selling general and admin expenses, also the same thing as our operating expenses. Some even call it fixed cost. It comes into play to also eat people supporting the business, the salaries, your utilities bill, right? Those costs, even though you don't incur them, you might still generate your revenue, but they are very, very important in supporting the business. We have that. Then we have our EBITDA. Now, if you look at management accounting will tell us, you have your revenue, you have your variable cost. Then they don't call their own gross profit, they call it contribution. And the reason it's called contribution is because after you've deducted your cost of sales, that is what you have left to contribute to every other line item that you have down to your profit. Then they will call the next one fixed cost. And they will now call the next one what? They call it profits. That's for management accounting. And we have two cost categorization, as we discussed in our last session, that cost can only be classified into two. Do we still remember? Which and into what category can cost be divided into? Remember, we mentioned that in our last session. And that's part of our assignment to also do. Anyone? Variable cost, right? And exactly. Cost can only fall under that too. Yes, I know we have different cost categorization, right? They say cost by nature, cost by management, different cost categorization. But the truth is, it can only be divided into two. So that this cost attributable directly to revenue or supporting the business, fixed. And management account will tell us, that is the profit. So revenue, deduct your variable cost. The next one, they call it contribution, right? Then they say, fixed costs, and we have our true profit. And from revenue down to that EBITDA, in which management accounting have actually categorized their own, is what we call a core business operation. And when it comes to valuation, so anytime you are in EBITDA, you say, EBITDA is very important to the business. It forms the base for valuing the business, right? It gives room for comparison, compare company A, business A to business B. And it is more like the true cash that is being gotten from the core business operation. So they say, let's try and look at our EBITDA and look at and compare that to cash flow from operations, right? Both of them supposed to move the same line, and the margin must not be too wide. So core business operation, we have our EBITDA. Then the next one that comes into play, depreciation, amortization, and both of them deals with use of assets. Basically what that is saying is, hey, I bought an asset in year 0. That asset, I capitalized it and took it to my balance sheet. The effect has taken place in my cash, right? But I now need to recognize the expense in my income statement. So that's why they call it a non-cash expense. But the truth is because you've recognized that expense in year 0 in your cash, and you are now expensing it. Oh, I bought this thing, I bought my personal phone for 1,000 naira. Oh, let's assume I'm going to use it over 5 years. It's as good as saying, oh, in year 1, you bought it for 10,000, spend 10,000. In year 2, you spend it 10,000. In year 3, 10,000. Yeah, so more like or 20,000, right, over the lifespan. So you now come here and recognize that as an expense. So it's not as if it's actually a non-cash. It's a cash thing, but it's because you recognize the cash in year 0 and you capitalize it. Right? We are now expensing it. Then we have our operating profit. Now, the next thing is you'll be like, wait, but we said from revenue down to EBITDA is a core business operation. So how come that guy called EBITDA is not called operating profit? You're thinking that direction. You're thinking right. Remember we said during our business cycle that you always start with your operating assets, use the operating assets to generate revenue, manage your costs to have your profit, and convert it to the cash. So in other words, it means there's no way you start a business without you having operating assets. Asset is assets, could be a non-current asset, could be a current asset. So as such, that asset, you actually use money in acquiring it. And it is what you are converting to generate your revenue. So as such, you must recognize it as part of your business operation. That's why you must always include depreciation and amortization before you have your operating profit. Then every other thing that comes, other income, finance income, finance costs, right? Your interest expense, your interest income, maybe the business is doing some other investment or retain generating revenue from other activities, you recognize it. And this is what we call the financing and investment section part of a business. Then we have a profit before tax. And after that, the government also comes into play and they eat in form of tax expense. And then we have a profit after tax. This is the best way for you to understand the structure of a financial statement as a modeler and also as an analyst. Right? And most times, because the structure of standard is different, and what standard is trying to do is trying to uniform how companies they do their recording and their presentation, right? But at times when it comes to we analysts, we usually restructure the financial statement to fit into this such that it gives room for comparison and you can see the true picture of what is happening in the organization. So from revenue down to gross profit top line, from our SG&A down to profit after the tax is what we call our bottom line. And from your use of assets down to you paying the government and everything, they can all be influenced by management decision. Now, with this, as I said, as a modeler, modeling, what we are trying to do is we are trying to forecast this line, trying to forecast this profit or loss account. And as such, you now need to ask yourself different questions, which will now take us to drivers in financial modeling. If I want to forecast my profit or loss account, what are the things that I need to ask? To forecast your revenue, what do you need? To forecast your cost of sale, what do you need? To forecast your SG&A, what do you need? To forecast your depreciation, amortization, what do you need? To forecast your other income, finance cost, tax expense, what do you need? And that's basically what we call drivers. Now let's take a look at it. For you to forecast your revenue, which we call the umbrella, definitely, as I said, any revenue must always comprise of a price, quantity. That's what will your business be doing? We want to be selling, we'll be manufacturing and selling our product. Good. What will be your price? How much will you be selling per unit? What are the total units that will be sold at a particular period? Then what are the expected growth? You say, oh, I'm going to, this year we're going to sell 1,000 units. Then, oh, year 2, year 3, year 4, year 5. What will be your expected increase in your quantity growth? Oh, increase it by 20% yearly or 10%. Then that's your driver. On the part of cost of sales, you go to your cost of sales as well. You're asking for me to forecast my cost of sales. What do I need? Oh, I need, you ask them, how many units, quantity will be produced and sold at a particular period? And what are the costs per unit? We are selling something at 100 naira per unit, then you're also asking, what are the costs for you to produce that? That forms your cost of sales. Deduct that plus profit, go straight to your SG&A. That's what will be your monthly expenses? What will be your salaries? How many human personnel do you need? What will be their monthly salary? What will be your subscription fee, your utilities being monthly, to all those costs that are attached to the business operation? That's what you're asking to get your SG&A. On the part of depreciation, you're asking, oh, what are the assets that you have? What are those assets that you are going to acquire by the time you are starting your business? What are the assets the business will acquire? And what do you think will be the expected lifespan of that assets? Right? The same thing, amortization. What are the some intangible assets that you will have? And what are the expected lifespan of those assets? And that will guide you in doing building the depreciation schedule. Then you go to the next one, other income, ask them, first they will have some other way of generating revenue aside their core business operation. You go to their finance income. Companies don't leave cash idle. Oh, what are your plans for your excess cash that you have? Are you going to be investing it, or you just keep it in the bank? You are investing it, what do you think will be the expected average returns that you'll be getting? Do you plan on investing in some other business activities? Then go to the finance cost. Will the business be using loan as their source of funding? If yes, what will be the interest rate? What will be the lifespan of the assets? Right? Then you have your profit before tax. Then you go to the tax. You're asking, what will be the tax rate? And definitely, when the business make profit, that's when they will pay tax. Then you have your what? You have your profit after tax. And that's what we call a driver. And that's all we are doing in financial modeling. Now start breaking everything down into different categories, just like we discussed during the business cycle. So we have revenue and cost modeling. How do you do that? Forecasting your operating expenses. How do you forecast that? Using some macroeconomic assumption and the whole thing. So for my asset scheduling, right? What are the different ways you can use in building that out? How do you build your finance schedule, right? How do you, we have tax modeling, different tax modeling, capital allowance, right? Deferred tax, accounting tax, and all those different things, tax allowance, loss relief, and the whole thing. Just now pick it segment by segment, but you need to understand the basic first, and then you can now take it further. And this is the best way for you to understand profit or loss accounts and how to use drivers. It does not mean you might be building for a company and most of them are not applied. So it's not a must that is applied to every business. If the business does not have loan, definitely there should not be interest expense in their profit or loss accounts. they don't have any plan on using their cash, depositing or reserve or investing it, then there's no need to have finance expense. If they will not have assets, there's no need to have depreciation. But as I said, there's no way business will operate without having assets, at least non-current assets. And that's the other part of the balance sheet. Now let's take a look at our, that's the part of profit and loss account. Let's take a look at our balance sheet. I said two most important, profit or loss account, then you have your balance sheet. I think cash flow was later introduced. People were kind of using our normal, typical cash book, the way we did before cash flow was not introduced. So, but once you have your profit or loss account, your balance sheet, you can automatically add your cash flow statement. So, I hope you understand that profit or loss account and drivers. Any question before we go to the balance sheet part? And do you think it makes sense? Is it different from the way we've been taught in our school? Okay, does it make sense? Do you understand it? Can you take a look at the company financials and say, oh, okay, so this is this, this is this, this is this. Is it different from the way we've been taught in school? Do you understand it better than the way we've been taught in school? Okay, all right. So let's take a look at our balance sheet. So before we go, now understand that in your profit or loss account, you can only have three things in your income statement. So when it comes to the part of data analysis, guys, right? And you want to categorize your income statement, they usually categorize it under three, and that's the truth. Income statement, right? You can only have three categorization of line item. And the first one is, number one, are you an income? Number two, are you an expense or a profit line? I'll repeat that. In your income statement, you can only have three categorization of line item. Number one is, are you an income? Or are you an expense? Or you are a profit line? So which means whenever you deduct any expense from any revenue or profit line, you always have a profit. Now let's look at this. Can you just mention one income line item that we have in this our structure? As I said, let's use chat box so that it's kind of smart, right? Can you list one income line item that we have in this our profit or loss accounts? So revenue, which is one, yes. Then another one, the other one. Other income, perfect. Then we have our finance income, exactly. Then on the part of the cost. So cost, cost of sales, operating expenses, depreciation and amortization is an expense, right? Your finance cost and your tax cost, expense. Then the third one is your profit line. So gross profit, EBITDA, operating profit, profit before tax, and profit after tax. And when it comes to ratio analysis, as I said, revenue is like the umbrella so that you understand where ratios is coming from and what it is saying. And that's why almost whenever you want to do your ratio analysis, almost everything can be measured against revenue. Because revenue is the umbrella. It's where everyone is eating from. So what's our gross profit margin? The gross profit divided by your revenue. What's our EBITDA margin? EBITDA divided by your revenue. What is our cost to income? The cost divided by revenue. What is our profit before tax margin? Profit before tax divided by revenue. Cost revenue is that umbrella. Now let's take a look at structure of our balance sheet. Balance sheet. For the balance sheet, you can only have two line items in your balance sheet. Balance sheet can only be categorized into two. It's either as an asset or funding. Balance sheet can only have two categorization. It's either as an asset or funding. So equity and liability, they are funding. Let's take a look, let's take it further. We said you can have assets and you can have funding. Just those two things in your balance sheet. And assets are more like the resources of the business, things owned by the business. Why funding, right, liabilities and equity, they are owned by the business. Remember, business is a separate entity on its own. So which means if you are starting a business today and you commit, let me put 100,000 into this business, the business is owing you something in return, because you automatically becomes liability to the business. The business must give you something in return. In other words, assets are resources of the business. Basically, how the business use the funds. Why funding is the source of funding to the business. Your equity, your long-term loan, your current liabilities. People that you owe money, you're supposed to have paid, but you are not, you are yet to pay them. They are using the money in the business. Right? And assets are internal to the business, while funding are external to the business. Remember, business is a standalone on its own. Equity investment, all those things, they are external to the business. Now, let's now take it further and let's look at, we've categorized it under 5. We call it 5 box balance sheet. We have our non-current assets on the part of the asset, and we have current assets. But on the part of funding, we now have equity, non-current liabilities, and current liabilities. Now, I'll give us an example of the line item. And what are the drivers? How do you get these line items as well when you are building your model? First one, now non-current assets, property, plant, and equipment. You always get that in your use of funds. Oh, I want to start a business today, and I'll be raising, I need funds of 5 million. Now, out of that 5 million, we're going to buy property, plant, and equipment, furniture and equipment of so amount. That is how you get your what? Plants and equipment for your non-current assets. All those, any expense that you can capitalize becomes part of this. So asking your client, you are starting your business and you need like 5 million, right? Good. So what are you using the 5 million? What will you use it to do? So you're going to set up office, buy some equipment, and then you have your property, plant, and equipment. Then you could have some other related items that can be capitalized. On the part of current assets, inventories. And the driver is cost of sales. So the normal way we calculate our operating working capital, right? Inventories can be found in your cost of sales. Also, what you are doing is you are trying to see how your balance sheet line item, how are they being linked to your profit or loss account, right? Inventory, you make production and part of it, those ones that are left comes to your balance sheet. So cost of sales is the driver. Your trade receivables, you sell to your clients and they are here to pay you. So it means trade receivables can be driven by revenue, prepayments. So part of your operating expenses that you prepaid. You also form part of our operating expenses. So for the balance sheet, you're just trying to see what is the link between this line item and my balance sheet, and you can merge them together. So you go to our operating working capital formula as well. Say, oh, inventory days divided by days in a period, multiply by cost of sales. Trade receivables, trade receivable days divided by days in a period, multiply by what? By our revenue. Then you could also have some other related line item. For cash and cash equivalent is when you build your cash flow, that you link it to your balance sheet to balance it up. And part of equity, so, you have the same thing as share capital, but most times we don't usually call it share capital because we use share capital for corporate organizations. So we call it maybe equity investment or investment contribution. So part of this 5 million that you want to raise, right? What percent will come from investors? What percent will come from loan? Then you have your retained earnings. When you make profit, you retain part of it. You pay some out as a dividend. Then on the part of your current liability, you're asking me, are you making use of loans in your business? If you have, then you're going to have long-term loans and borrowing. Then for the part of current liability, you have the cost of sales, operating costs, and your accruals, right? And also other related line item. Now, with this, your understanding, as I said, what you're trying to do is to forecast your income statement, balance sheet, and you automatically have your cash flow. So with this understanding of the driver, now let's now reflect our business cycle, right? We said we have a business canvas, business model, what the business is all about, the whole thing, understand it. Then we start with general macroeconomic assumptions, which will go straight into our financing assumptions, our capex, our plan to use the funds, right? Our working capital and some operational cost, then revenue and cost, and we do our calculation and we have our output. So in getting started, we sent a questionnaire to the client, and the client was able to fill the questionnaire for us. So one thing I want us to do is let's run through this. Ready? Understand? Oh, this is the driver for my income statement. These things I need. My balance sheet, things I need. So which means you now use that to ask the client the appropriate question, because they are the first source of information. The best source of your assumption is always good to ask your clients. Now, your client does not understand you saying, oh, I want to forecast this, I want to forecast that. You think they will give you automatically. No, you need to draft a questionnaire that will give them that will serve as a guide for them to be able to answer and give you what you want. So I would like us to go ahead. Let's open this 01 file. Let me also see if I can drop it in the chat box for us. So I shared that on our WhatsApp group today. So let me check. So let me drop it on the chat box for us. Okay. All right, so I'll also drop it in the chat box. Let's open it. So let's run through what this business, what is all about. So this is a sample brief from a client. Right, so let's kindly go ahead and let's open it. Okay, all right. So let's open it together. And this is one thing I want us to do. So we want to do one short activity. So we'll be reading each of the questions, and then we'll now be asking ourselves, oh, why was this question asked? And what will this give us in our income statement, in our profit or loss account, and our balance sheet? Which line item will this answer? Which line item will this answer? Which line item will this supply us? Right? All right, so let me confirm. I'll find the file. I've dropped it in the chat box. I also shared the link in the in our WhatsApp group. Yes. Let's kindly confirm. If you have the file, let's open it. Let's open it so that we can run through it together and you understand the whole thing. Once you understand these parts, right, building the model will now just be what we now focus on. So let's kindly confirm you have the file open before we now run it together. Yeah, I know some of us are joining through our mobile phone. Okay, all right. So let's start from the first question. Just asking about the company details. So you can be creative with the way you prepare your own questionnaire. But the main thing is, once you understand that, oh, I asked this question, which line item is it for me in my financial statement, right? So what is the name of your business? So definitely you need to know the name of your business, right? Put the name of the company. So this one is saying modeling limited. Where is your business location? Now, let me ask you, why do you think we are asking for the business location? Anyone?
to ascertain the demand and the market for the business, general market for the business.
Okay, I agree with you. Yes. But I need some other things, right? Well, you are building a model. Yeah, it's not as if you are writing the business plan or doing the market research. Already done that, running the model canvas. Okay, good. So to know the currency to deal with, I agree with you. Yes, some other things. What do you think we're asking? So let's make use of the chat box. Perfect, Tomiwa. Exactly for the macroeconomic assumption. Perfect. So determine the audience and your thing that would have been done in during the phase of what of your macro of your business model and business canvas, and it's more like the work of the business analyst and the whole thing. The reason why you need this is to be able to determine the macroeconomic assumption. For example, the business that is operating in Nigeria cannot use USA tax rate. You cannot use USA inflation rate for it, right? So which means the business is operating in Nigeria, you are using Nigeria data for it. You're using Nigeria inflation rate, right? You're using Nigeria market growth and the whole thing. So that's why you need to understand that location. You're using Nigeria tax rates. So we'll take a look at that. Describe your business briefly. You need to understand what the business is doing. So buying and selling of paint products at large to customers. So they buy from the manufacturer and they sell. So they are more like a distributor. How much investment do you want to raise? 250. Now, do you have a previous investment in the business? If so, how much and what expenses did it cover, right? So you need this to be able to, maybe the business has been operating before, or they have some assets and the whole thing, which means you will need it and add it to your asset schedule. Now, what is the funding plan for the short-term and long-term loan? Bank loan, personal finance, or equity? So they are telling us a bank loan of 100,000. So now let me ask us, what line item do you think this will help us solve in our financial statements? So let's type it in the chat box, right? So that we have a smooth one. So they said the bank loan of 100,000. Which line item do you think this will solve for us in our financials, our balance sheet and income statements? So yes, let's list the name of the line item. Let's list the name of the line item. So finance cost, exactly. So that means, let's say bank loan of 100,000, that means automatically they must have interest expense. And then you know that they will have, whether they are non-current liabilities, they will have loans, long-term loans. An equity investment of 150. What do you think this will also solve for us in our financial statements? Which line item do you think this will solve for us? Which line item do you think this will solve for us? So let's even complete the first one. So for the first one, right, say a bank loan of $100,000. So that means you're expecting, definitely we are going to have interest expense in our income statement. We're going to have current liability, long-term loan, liability. We are going to have a cash flow repayment in our cash flow from financing as well. We also have a cash inflow of loan as well. For the equity, definitely you have your share capital coming in into play. So that's equity. So funds are expected to come in before the business kickstarts. If loan, how many years to pay? So this also goes with our loan. So that means this is telling you the principal. So you're going to have interest expense for 4 years, right? Principal repayment in our cash flow for 4 years, and the loan outstanding for 4 years as well. If equity, what percent of profit sharing are you offering? 30% payout ratio. That means that is telling you about their retained earnings, which will go into the balance sheet. Give a breakdown of how the company plans to use the capital to be raised. right? And we also have dividend payouts in our cash flow. Thank you for that. So give a breakdown of how the company plans to use the capital to be raised. Business registration and professional fee is one. We form our pre-operational expenses. Research, furniture and fitting. Automatically, you already know that, oh, you have asset one, you are going to have depreciation. Plant and equipment and other assets, you're going to have depreciation. Websites, intangible assets, and go to have amortization. Inventory products, $75,000, which will form part of your cost of sales. You need to get the material, the product, and the marketing. PRO of 10,000, rent 15,000, insurance of 5,000. Say, oh, kindly help with other costs. You assume to also be a financial advisor. Oh, you might be incurring this cost, you might need this, you might need that, you might need that. Please list your product, service, and their respective prices. So which means you are coming down to your revenue, right? List the cost attached to it. They are telling you the cost per unit for your cost of sales. List your customer base number and expected customer growth expected for the forecast period. Oh, target is to sell 200 units monthly for product 1, 200 units for product 2, and 400 units for product 3 monthly. What is your plan for staffing? So you know that, oh, you already have your, so this 3 line already gives you your revenue and your cost of sales. Because you have your price, you have your quantity, you have your unit cost, right? You already have that. What is the plan for staffing? That is, how many personnel are you starting with? And what salary plan for them? Definitely, you are building out your salary schedule. Sometimes the client might not even be able to provide this for you, which means you now need to do extra work. Go online, research, look for a related company, or use your typical business knowledge, your business understanding together. How many locations are you planning to cover each year? So they say, oh, if cash is enough, right, they will open another shop in year 4, open with the same capex that they have. Can you list out the expected monthly expenses and their amount? Right, so rent, utility, maintenance, and they've managed to give you. At times, it might be difficult for clients to be able to supply all this information. So if something like this happens, what you usually do is you build the model, you do your research, but you let the client know that, oh, this will be more like a first draft model for a discussion. Because at times it's when they see the number that their brain will not, oh, okay, well, we cannot spend up to this, we'll do that. But at the initial stage, it might be difficult for them to even feed you all this information. So now with this, the next thing, after we've gotten this questionnaire, prepare it and send it to our client. The next thing is for us to now get started with our model build. And part of what we did in our pre-work was creating a professional model template, which we all submitted, right, before we started this. And it's the same template that we will be using in building this our model. So I will assume, yes, you can review recorded videos on my YouTube channel as well. So let's start from the input worksheet. Now, this is one thing I want us to do, because we are now going to the artistical part of it. We've taken our time to run through the mechanical aspect of it, you understanding business and how it's translating into financial model. Now we are going into the artistical part of it, how you apply those mechanical knowledge to this. So looking at our business cycle, we said we're going to start with the general macroeconomic assumption. So this is one thing I want us to do. Look at my home, look at how I'm doing it, right? Understand it, and you can always go back. Just build that into your own as well. Please, don't assume you understand it when I'm doing it alone. It's always good you take your time to do it on your own. That's the best way to learn financial modeling. You do it on your own. Make a mistake, get better at it. So let's start with our, let me call this general general and macroeconomic assumptions. Right? So I'll put this in our heading 1. Let's take a look at some general assumptions. Start with the general assumptions. There's always good when you're building your model, make it look good, professional, be professional. So let's take a look at some general things, some general assumptions that can affect the business as a whole, right? Can you give me an example? Some general thing that you know, irrespective of the business you are doing, it will apply to you. So general. So general assumption is different from macroeconomic assumption. So let me give us an example. Let's say months in a period. Months in a period for this. Let's call this month. Right. Months in a period. I'll put it, remember, following our financial modeling standard. So a month in a period, that will always be 12, right? For each period, we need to put decimal. So 12, right? So days in a period, days in a period. Put this as days. So it's good to always follow the modeling best practice. Please add units, it's an input, put it in input format as you've stated here in your model style guide. So here we can just use formula to say the current date, the current end date minus previous end date, and that will give us days in a period, 365, 366. So we have that for the respective period. So you see, this is a formula, and I'm also following my style guide that I've created. That's always the best way when you're building your model. So what other things can we have? What other things can we have? What other things can we have? So let's say quarter in a period. How many quarters do you have in a period? Anyone? How many quarters do you have in a period? 4, right? Okay, so put this. So we have 4 quarters in a period. So months in a quarter. So months in a quarter. So at times when you're also doing this, you should understand the model. As I said, most times you always start with something called back of the envelope. So you first build the model like as if you are drawing a picture. And say, oh, do I need this? Do I need this? Oh, for me to do this calculation, do I need this? And you can always come back to your input and also add to it. So 3 months, 3 months. Any other thing? Any other thing? Okay, so let's say our period counts, right? So yes. For this, I'll just put formula as well, equal to previous year plus 1. So yes, we have 5 years for our forecast. Simple as that. Now to the next one, I can just copy this header here. I'm going to call this. This will now be our macroeconomics. This will be our macroeconomic assumptions. This will be our macroeconomic assumptions. So now let's deal with this part. This part is very, very important, and I would like us to take our time to understand it very, very well. So the first one, let's call this our cost incremental rates. Let's call this one our cost incremental rates. And first one that we're going to check under this is what we call inflation rates. Inflation rates, and I'm going to put it in percent. So let me put this as input. So that's I'll zoom out very well. Here. Okay, so for our inflation rates, right? And said that's one of the reasons why you need to understand where the business will be operating, right? And to get that, almost all the country in the world has inflation forecast. So I will just go to Google and I'm going to type inflation forecast for the next 5 years in USA. So you can put your own country and you think, and you will see different one, right? But most times it's always good to check more than 2 or 3 websites for you to be able to confirm that yes, you are sure of the data that you will be using. So let's take a look at this. Let's take a look at this site, statista.com. Let's look at their inflation rates cast, the projected annual inflation rates. Okay, slowly in my network. Why is this slow? Okay, all right, so good. So here we have the inflation rate forecast, right? And I'm going to split my screen into 2 so that I can extract this. So it's always good anytime you are using any external data in your model, right? You copy it. I'm going to copy the link and I'll come to my model, right? Here, I can right click and put new note. And I'm going to call this new note, right? Let me delete this. Okay, because I use my panel like this. Okay. So let me delete my name. I'm going to put source so that anyone can just pick this and understand where this is coming from. Another thing that you can do, seems my system is a little bit slow. Let me try and close some application. Okay, so we have this. Another thing you can do is when you create your model, all right, maybe part of your model guide, you could have some what we call data, call it data source, right? So maybe you don't want to put it like that. So you come to this, your input, maybe you just put something like a link, or you just type source here, right? Then you right click, put link, you click on this link. So you put, so maybe you come here in your main worksheets, right? So that's more like one. So maybe you put inflation, so inflation rates, right? Then you paste the link here like this. Then you come to this, your input. So I think this should be cell what? This should be, so you add the cell number, cell C19. So you come to your input under this source, right click on the link, place in this document, then you select the summary worksheet. Inside they type the cell reference, you type the C19. So maybe you can put some script tip here, so you get this, the source of the data. You click on OK. So you click on OK like this. So when someone over on it, to show them where you get the source, and when you click on it, you just take them to, okay, so I'm supposed to select menu. So come back, let me edit it. So right click, click on edit hyperlink. This time I'm supposed to click worksheet menu worksheet and click on OK. So when I click on this source, it automatically brings them here. Right, and that's how to do that. Okay, so let me extract the data. So for 2020, 22. Currently now, I think they are 7.8. So let me see. So this should be 7.68. I'll just type that. So let me convert this to percent. Put it in a percent format. Okay, so 7.8, 7.68, 7.68. Right? Then here, 2.86, then 2.26, 2% here. Let me switch on this this application. So 2%, and here 1.97. I would not make mistake. Okay, so let's start from 2023. Let's do that again. So 2023 is saying 2.86, right? 2024, 2.26, 2025, 2%, 2026, 1.97, and 2027, 2%. So you have this. Now, let's now look at what is the effect of this inflation. So I'm also going to give us an example, right, so that we understand this and before we start applying it. So you have incremental rates. Let's assume you're saying, hey, I want to spend 5,000 today. We're going to have an expenses that will be costing us 5,000. Right? So now inflation is saying, yes, 5,000 naira might buy something today, but that same 5,000 naira might not be able to buy it tomorrow. Let's take a good example of my country, right? I think that some years ago, they sell Indomie for how much? Let's say you want to buy one pack of Indomie for how much? Anyone idea? Okay, maybe we should just use one piece, all right? Let's say Indomie was selling at 15 naira. A very good example, 15 naira then. So how much is Indomie noodles now? The smallest one. Any idea? Anyone know? Anyone has idea? How much is Indomie pack now in Nigeria? Some years back, they were selling it at 15, right? Now it's 100, in fact, some 120, right? Exactly. And that's the concept of what inflation is saying. That, hey, yes, let's assume you were making provision for some expenses that's 2 years ago. You open it, you still send 15 naira, 15 naira, 15. Now it's 120. That means you need to have made provision for times 2 of that expenses. And that's the same thing inflation is saying. Say, oh yes, 15 naira today. And basically that means you're saying equal to your base year multiplied by, open your bracket, 1 plus this what? Your inflation growth rate, close the bracket, enter, and I can drag that for each year. So this is you making provision that, yes, it's as good as I'm saying I'll be spending 50 naira, right? But because of inflation, I need to factor in some other variable, some other thing. So better I make a provision. So let's assume this is supposed to be 50 naira, right? And let's now deduct the effect of inflation from this amount. So we are saying, hey, I need to make provision for additional $1.4 here. Let's assume this is in dollars, right? I need to make another provision of 2.6 in here, 3.6, and that is more like the effect of inflation. When you say, I'm going to be spending this amount monthly and all those things, you also need to consider that. Do you understand that? So let me call this our first method. So let me call this method 1. Let me call this method 1, right? So you have your input as your base period, and you are increasing it by what? You are increasing it by the growth rate. Straightforward, right? Straight to the point. And the formula we use is what? Last year value multiplied by what? Open your bracket, 1 plus our growth rate. That's the formula that we've used, right? Now, let's take a look at method 2. So most of what we'll be doing, I would make sure I give us more than one method when we are dealing with the concept. Method 2. For method 2, it is assuming that, okay, yes, let's assume this 15 naira will be constant, right? And for our inflation, so let me call this, okay, we have to call this cost. So here we call this cost. Now there's something we now call inflation factor. The session is being recorded. Yes, don't worry. So I just want us to understand it, ask a question, then you can go ahead and apply it in your own and use that to do it. Now, there's something we call inflation index. And this inflation index also has 2 methods. So the first one method is this. We assume base year to be the same thing, 1. Right? We're now saying equal to, we increase this 1, the ones serve as a base, multiply by, open my bracket, 1 plus this my inflation rate. Right? Close the bracket, enter. And this will give us, well, we usually put this in a multiple sign. I think we created it exactly. So this will now give us in a multiple sign factor. So basically this is saying is, hey, this year is going to keep, it still give us the same thing. So let's look at the actual cost now. So the actual cost, which we expect will now be equal to the 15 naira multiplied by this inflation factor. And see that it will still give us the same thing with what we add in method 1. Do you understand that? Or I should run it again so that you understand it. Do you understand that? You understand that? Okay. So here we are saying, let's assume, yes, we'll be spending 50 naira, 50. Okay, should we use dollar or naira? For each respective years. We're saying for our inflation, since we have inflation rates, we now need to convert this inflation rate into factor. And to do that, we're saying, hey, this period should be 1. 15 naira in today's 15 naira. And we are now increasing this 1 multiplied by, open my brackets, 1 plus this inflation rate that I have. Close the brackets, enter, and I will drag it for the 5 years. And this time, I'll come in and type equal to the 50 that I've recognized I'll be spending each respective years, multiplied by what's the inflation factor. Enter and drag it for the years. And it will still give you the same thing. You still give you what? It will still give you the same thing. Just the second method and the second approach that we use. Now, let me now ask you, what do you think is the benefit of using method 1 or using method 2? Taking a look at this. So you also, so the artistical part also require you to be able to think. Yes. So let's take a look at this together. Which one do you think is better? And why do you think you want to use method 2 or why do you want to use method 1? Anyone? Method 1 is faster and straight to the point. I agree with you. Yes. Why do you think we have method 2? Take a look at it closely. So as a modeler, you should be able to look at it. Okay, method 1 is more easy for anybody to read and understand. Yes. Why do you think we have method 2? Take a look at it closely. What's the benefit of using method 2? Method 2 shows the inflation factor from side. I agree. What other benefit do you think we have when we use method 2? Method 2 kind of capture possible changes. I agree with you exactly. Method 2 shows the inflation and only need to multiply with. Yes, but let's take a look at this. Method 2 kind of gives room for updates. update. Let's assume the business now want to expand and might likely increase their expenses, or because of one or two things, the expense kind of increased. So then, oh, maybe in year 3, you know what? Let's increase this. Let's assume this will increase to 60 because of expansion and business growth. So which means 60, and let's say this 60, then in year 5, this increased to 70. Now, let me ask you, do you think this kind of change can be done to method 1? Now look at it. Which method would you prefer now? Method 1 or method 2? Looking at the example that I just gave us. Remember, standard is saying you build your model, it must be flexible, it must be able to incorporate future changes. Send it to your client say, okay, oh, yeah, remember, yes, year 1, year 2, but year 3, the expense might increase because we need to increase our revenue. Maybe let's even assume the cost, this is marketing cost. So we need to increase our marketing, so which means method 2 is more dynamic and it gives room for that flexibility. But doing that in this year 2 might be a little bit difficult, right? And that's why we have this method 2. Most times, I usually prefer this method 2 when we are dealing with it. We also have method 3, but that method 3, I think, let me suspend it for now. Okay, or should I show us the method 3? Should I show us method 3? Should I show us method 3? Okay, so let's look at method 3. So let's look at method 3. So method 3, method 3. So method 3 is also assuming the same thing that, hey, yes, we are going to have our cost like this. So, so for method 3, it's consider period. So let me say this plus 1. So I'm just using this as an example. This plus 1. So this is our period. This is our cost. And let's now get our inflation factor. Now let me bring the inflation here so that we can have everything. I see everything at once. So these are inflation rates, and these are inflation. So let's calculate our inflation factor. Now for the inflation factor, it considers timing, and the formula is different. So for the formula is 1 plus the rate, right? What did we use there? Okay, so let's be consistent. 1 plus our growth rate, right? Then raised to, open my brackets, my period minus 1. My period minus 1. 1 plus growth rate raised to power period minus 1. So for some of us that we've done SFM, I'm quite sure you would have seen a formula like this, right? When we do our time value of money, there's a name we call this formula, annuity formula or something like that, here under annuity concept and the thing. And this one is saying equal to, open my brackets, 1, no, this is not terminal value. So 1, yes, it's family of annuity of the thing. So 1 plus, this is our inflation rate, which is the growth rate, close my brackets, then raised to, open my brackets, my period here minus 1. Now close the bracket and press enter. Then I'll drag it for the 5 years. Put this in our multiple sign. And let's take a look at this. Now, for this formula, it's assuming that the cost we set today will be the same thing for at least for our first year of our forecast. It's keeping it constant. Then it will now increase it respectively for the other period. So which means we now take a look at our actual cost. Our actual cost here equal to costs multiplied by inflation factor, up that for the 5 years. Now let's take a look at this. under our method 2, our actual cost, let's look at our actual costs for method 2 and let's look at our actual cost for method 3. So it's a year. So for this annuity, it's assuming that year 1 is as good as year 0 exactly. So out of this method 2, so we assume method 2 and method 1, they are more like the same thing, right? Just that method 2 gives room for flexibility. But method 2, let's look at method 2 and method 3. Which would you prefer to use and why? Which would you prefer to use and why? Method 2 and method 3. Look at method 2. Method 2 is telling us the cost will be 51. Method 2 is telling us, oh, this will take us 51 up to 78, but method 3 is saying 50 down to 75. Method 2, method 3 is more complicated. Method 3, so nothing is complicated, right? So stop saying method, there's no method that is complicated. You just need to understand it. And that's why finance is great. Finance is flexible. Finance is adjustable. So for some of us that we are good with SFM, you realize that one guy will develop this model, then another one will show us the strength and the weakness. Then we go and develop another one. Does not mean the first model is not good, right? Because they've recognized some weaknesses. One will go ahead and create another model, right? Create another model. Also, someone else will query, we say, oh, there's the weakness, there's this and that, and we go ahead and create it. So that's what makes finance great. It is flexible and adjustable. Yes. So prefer method 3 because I can adjust all my variables. Yes, you can also adjust your variable here too. It's the same thing applies. It's just that inflation factor that seems different. Right? So one method, so we call this one aggressive. We call this one aggressive method. Right? Why we call this one a conservative method. Do you understand that? Do you understand that? And if you look at it, you will realize that this one is very, very aggressive. In year 1, is already assuming, no, the time value will already be 51.4. We are spending more. Let's say equal to, right, our actual cost minus the actual stated cost. Say no, we are spending more. And for method 3 is saying, let's say our forecasted cost minus the initial cost. So look at this one. So method 2 is already saying aggressive that if you sum it together, that we'll be spending more of 22.1, where method 3 is saying we'll be spending what? Just 12.9. So method 2 is aggressive and is very high, while method 3 is conservative. And I think they call one nominal and they call the other one real. For economics guys, I'm quite sure you understand that one. Oh, this is the nominal rate, and this is the what? This is the real rate. So you can always check that on your own. Call one nominal and nominal rate, right? So you have nominal rate and you have your real rate. You can see that. So I think the method 2 is the real rates, right? Method 3 is the nominal rates. I'm not sure. You can always check that on your own. So you can see the reason why being a modeler is very, very important. And when companies want to hire any finance guy, you must be sound in financial modeling, because financial modeling is broad. Now picking from here, picking from here, picking from there, picking from there. Now just looking at only this one single concept. We've gone to SFM, right? We've gone to economics, just going up and down, gone to time value of money and the whole thing, right? So I think method 2 is preferable because it goes with prudence stuff. Exactly, I agree with you. Right? Right. So number 2 is aggressive. Number 3 is conservative. Now, at times, what we usually do is this. We usually build a scenario around it when we are building a model. And that's why we call it a model. So, okay, let's look at it. If we use our cost as being aggressive, what will be the impact on our profits? If our cost is conservative, what will be the impact? So at times you can create scenarios around it as well. We create a switch button where they can just select and see the impact. Yes, method 2 is good, right? Because more like a prudent stuff, right? So and when we are building a model, we're saying, hey, try to under forecast your revenue and over forecast your cost, which is what this guy is saying here. So method 2 is, well, we say modeling concept say, oh, forecasting, when it comes to forecasting and projection, under forecast your revenue and over forecast your cost. Now, this is good, but for a model that has a longer period, this aggressive cost might not be 100% good. For a model that has a longer period, let's say 10 years, because you're saying, hey, I want to, you want to keep, let's assume you want to keep your pricing constant, but inflation is increasing aggressively. So it means at the end, you just see that your cost is just eating up your revenue, your revenue, because you've kept your price constant and cost is increasing aggressively. So most times for a model that has a longer period, right, we might want to use the conservative approach. But now that we have the understanding of this, so this is not where we are going, so I'm going to delete it. I'm going to delete it. Should I? Yes, I think I can delete it, right? So let me delete it. I just use this as an example. And don't worry, it's also being recorded. You can always check this out. Your home. So now let's put this in our model. So we're going to use both scenarios. So let's call this one our conservative. So okay, let's do it under here. So we're going to call this our conservative factor, and then we call this one aggressive factor. So let's use that. Let's use it to create a scenario. All right. So remember the formula for the okay. I think we should do the aggressive one first. So let's aggressive come first. So for the aggressive, I said you put one here. We stand as a base. What we're saying today is today. I say equal to my base multiplied by my bracket 1 plus my inflation rate, close bracket, enter. Drag it for the 5 years, put this in a multiple. Therefore, conservative is saying equal to, open my bracket, 1 plus my inflation rate, then raised to, open my bracket, my period here, minus 1. Close the bracket, enter, and drag that for the 5 years. Put this in multiple. Hope you understand that. So 1 will always be 1. So let's just leave that. Then we now need to now put here inflation. So let's say inflation factor used in model. Right? And let's use that to create a scenario. So I'm saying my aggressive is 1, my conservative is 2, right? So now to make this work, I'm going to type 1 here. So this one that I've typed here, basically what I'm saying is this. So let me put the formula so that in case some of us want to take a look at that. So this one is last year, right? Multiply by my brackets, 1 plus our growth rate. While the second one is saying 1, open my bracket, 1 plus my growth rate Close my bracket, then raised to what? My period minus 1. So now let's take a look at this. So which means whenever I type 1 here, I want it to give us the what? The aggressive factor. Once I type 2 here, I want it to give us the conservative factor. Right? But I don't mind if it's the only thing you understand today, because this is very, very important when it comes to modeling. So type 1 here, 1 is simply say, oh, give us the aggressive factor. By type 2, you say, give us the what? Conservative factor. What I'm going to do is I'm going to rename it. This cell, I'll come to my name box. If I show you watch the pre-work video, you should see this. Click inside my name box, and I'm going to name it my inflation. I'm calling it inflation underscore switch. So I must look at the spelling. The spelling must be correct. Enter. This aggressive factor and conservative factor, I will highlight both of them. Come to my name box and call it my inflation underscore list. And use any name you want. Enter. So I've renamed those two guys. I'll come in here and I'm going to type equal to, I will use a formula called choose. So that whenever I type 1 here to give me aggressive factor, whenever I type 2 to give me what? Conservative factor. So I'm going to use this formula called choose. Choose index number. This is my index number, which is that number that is switching. Remember, I've renamed it to inflation switch, comma, and it's asking me for the first value. So the first value is what I have here, aggressive for year 1, comma, and what? And the conservative for that's in year 1. Close my bracket and press enter. Put this in my multiple. I can just drag it for the years, for the 5 years. Right? So if I type 1 here, if I type 1, see, just give us what we have under our aggressive. If I type 2 here, it's going to give us what we have under our conservative. So which means this is what we are going to use in the model. So what I usually like doing is these guys, I will just try and reduce the font color. So from that black, maybe I'll just reduce it to something ash. Which means this is the inflation factor that we'll be using. Now, we don't want our clients to come here and be typing 1 or be typing 2. They might not even understand what this is saying. Right? So that's now lead us to what we call using of combo box to create scenario. Right? Using combo box to create scenario. In fact, you can add some other scenario to maybe you want to keep everything at 1, 1, 1. Let's say inflation is the same thing. Our cost will just remain the same thing for the forecast period. Put that in. Maybe you have some. Maybe they say, you know what, you want to have some cost rates. Maybe the client says, okay, you know what, everything will increase by 10% year on year. You can have that. So you can create that scenario. So now you don't want your client to be typing 1 here or be typing 2. They might not even understand what it means. That's why we now need to use what we call combo box that restricts your users to certain selection. We don't want them to be typing 1 or 2. You just want them to type, just select aggressive inflation or aggressive inflation factor or conservative factor. So to do that, you have this guy we call developer tab. So maybe in case you don't have this in your home, you might need to go to your file tab, right? Go straight to your options and click on customize ribbon. So under your customize ribbon, you come to this your right. I'm facing my screen now, so by my right, and you'll see this main tab. And here, your developer might not be clicked, so just make sure you tick it. And make sure you're using updated Excel, right? Then click on your OK, so that you have this developer tab that will show. So once you show, just go straight to your insert under your control tab here. Under your control tab here, right? You will see this guy called insert. See this guy called insert. So just click on the insert, and it will bring out form control for you. So You can explore this on your own. So we need the combo box, and I'll just select the combo box. Now, once I select it, the icon of my laptop will change to something like a cross, and I will left click my mouse and just drag it as if I want to draw. Then I can have this shape. Now, this anything that is not in a cell in Excel is not Excel. So which means for it to work with Excel, it must link with something in a cell. So currently now, this has nothing to do. But want our client to be able to just pick aggressive or conservative from this box. So I'm going to right click faster. So if you right click slowly to give you this option of move, copy, cancel. So you need to right click faster, select format control. Once you select format control, it's going to open up this form control tab for you. The first thing is asking you is input range. So our input range, anytime you hear anything like range, just know that it's an array, right? Either in a row or a column. So here, I think we name it, remember we created that name. So we call this inflation underscore list. So the name must be the same thing with what you've done, where you've created it. The cell link, we call that one our inflation underscore switch. And click on OK. So once you click OK, you've transferred the control from this cell to this combo box. Everything will go back as error, as if it's zero now. Then you come to your drop-down option and you can see that guy here. So when you click aggressive, see it changes it. Once you click conservative, it's just automatically select it. And your client don't need to be putting one. So here what you usually do is you can put this into maybe a white color or something stupid or something so that they don't go and delete it, or at times you can make it white font. So this look as if there's nothing there. And it looks like this, then they can always select from this conservative. Right, you can make this look good. Maybe you put insert, so you can put a text. So then you put a text and put and even make it more like the same shape with the combo box, right? And I can call it inflation. So I can put inflation and I can adjust it so that it looks good. And put maybe something like ash light color or something that just shows, right, so that it's easy for someone to see, right? And I can group both of them. Control, select both shape, put your shape format, then you group both of them together so that it just become one like this. I can move it anywhere. I can move it anywhere to any worksheets, and it will still be working, right? And that is how we create a scenario. So I've also introduced us to how we create scenario when it comes to you building a model. So you can always take this to any worksheet or take it anywhere in your model. Most times it's always good in your summary, but you create it here, take it to your summary, and they can always, so by the time you build the model, everything is working fine. You switch this, you see the effect, you see the impact on your model. Right? So where can we keep it? Yes, and just put it somewhere, at least for now. So we can move it to our summary by the time we are done with our model build. Right? So I know it's getting interesting, right? And this one I will say, hey, there. So you can see we've just gone through the mechanical aspect of it, and now we are going to the artistic part of it, how you apply it. So it's always good to have this understanding that said this is more like the concept entirely on its own. We've taken our time to run through this. So let's stop here today so that I don't overload us with too much, so that you take your time to practice this. Please, it's very important. All right, you're taking a look at the way I'm doing it, and it seems to be very, very easy. No, the more you do it, the more you build, the more you practice, the more you get better at it. Right, this is a work of over 3-4 years, right? So it might look easy. The truth is, it's not that easy, right? Any concept I'm taking you now, it means I've had to practice it more than 10 times before I could master it, not do mistake, because this is very important. People are committing invest a lot of money, right, based on this. So you need to understand it very well. You can go online, read more, check what's the inflation saying, what's this and that and that. So let's drop our mic here today so that I don't overload us with much, right? And the next session, we'll continue from where we stop. So is that fine? That's fine. Do you have any question with what we've done so far before we call it a day? Any question? Any question? Any contribution? Any contribution? I hope I've not loaded us with too much, and I hope I'm not scaring us. Right? So modeling is actually simple. What you just need to understand the whole reason behind why you are putting this value, so that when they ask you, you can always defend it. Right? Okay. So, all right. So, thank you, everyone. Thank you for your time. Thank you for your presence. Let's make sure we enjoy the rest of our weekend, and we'll see us in the next session. So, yes, take your time to reflect on what you've done, right? Understand it, practice it, build this, check this out. Also, go online, check some people's model, all right? See how they apply the inflation rates in their calculation. And the next. So the next meeting, we're going to discuss that in our group chat. Yes, yes. Let's make sure we practice this. All right, check models. So go to my portfolio website, download some sample model that I have there. Look at how we've also include these in the model. All right, so thank you, and let's make sure we enjoy the rest of our day. So bye for now.